What if everything you've been told about real estate investing in 2026 is wrong? Rates are too high, deals don't pencil, wait for rates to drop. I'm sure you've heard it all. I've funded hundreds of investment property loans over the last year, and what I'm going to tell you might surprise you. Investors waiting on the sidelines, waiting for these perfect conditions, are going to lose out on the biggest opportunity of their lives if they don't start digging in and figuring out how to make it work in this market. My name is James Miller. I've funded hundreds of investment property loans all over the country, and I love helping investors like yourself grow their portfolios, make their next move, and play the game of Monopoly. So let's get into how we're going to help you win in 2026. So let's first address the big elephant in the room. Real estate is dead in 2026, right? Not exactly. People are doing deals right now. Last year I funded over 100 loans, and after I did that same thing basically the year before. Now, obviously, if you listen to the news tell you that people are not buying homes. And that's actually true. The data backs it up. Back in December, even of last year, in 2025, people were not buying homes. So why? Well, everybody wants to blame the interest rates, and that's what I hear from investors, right? Oh, the interest rates are too high. But is that really the problem? Because if you look on a historical basis, not just over the last 10 to 15 years where we were blessed with these very low interest rates, if you look at a 30, 40, 50 year time frame, interest rates were a lot higher, and actually they typically would average around 6 to 7%. So is it the interest rates? I actually think that it's the values. I think that because we drove interest rates so low for so long, in the 2010s it was generally around 3, 4, 5%, and then the early 2020s during COVID, we drove these things down to 3, 4%, and I even had a few clients I did rates for like 1.99, 1.75% on 15-year notes. Crazy. But the point being is those low rates drove us into this position where everybody was buying real estate, everybody was buying stocks, bonds, gold, silver, crypto, that all the asset values went so nuts. Well, that was fine for stocks and bonds and crypto and everything else. However, for real estate, it becomes a problem. Why? Because now we're in a situation where as we try to balance this thing out, where we drove the rates down for so long that we created this huge bubble, well, now we have a problem with the bubble. The values are so high, people can't afford them. The biggest thing to note is if you're trying to buy an investment property, things are starting to become in your favor. And what I mean by that is that the values are starting to come down. Over the last 2-3 years, sellers are trying to get out of these homes, and of course they had this big idea of what they thought their value of their property was, but now they're starting to cut their values. And this first was happening in Florida and Texas and some bigger markets, but now it's starting to happen all over the country. And so you just have to be patient to make sure you're choosing the right deal. The one thing about the real estate market is that it's not like the stock market or crypto. It doesn't just fall off a cliff or just tank. It takes time for it to go down. The reason why is there's a different psychological thing around your home. You sell a stock, even if you take it for a little bit of loss, it is what it is. But selling your home for less than what you bought it for, that's blasphemy for most people. So we've already been in this downward trajectory over the last couple of years. I think it'll continue to happen here in 2026. So as we're on the downward slide, that means that there's going to be opportunities to become available. You just got to be ready for them. So that takes us into section 2. So while a lot of investors are still sitting on the sidelines, there's a group of investors who are killing it in this market, still making money, still building wealth and growing their portfolio and playing that game of Monopoly, like I like to say. So let's get into what they're doing differently from everybody else. So first off, let's talk about who's closing deals in this market. It's the experienced investors. As somebody who works strictly with investors, more of the people that I'm speaking to, usually people who actually have a lot of experience, or they've had experience in the past. And the main thing that these people are doing differently than the rest of the market is they're not just accepting status quo. What I mean by that is when they look at a property, they're looking at where can I add a unit to the property? Can I turn the garage into an additional unit? Or they're taking properties that are single family homes and turning them into duplexes. In fact, one of my clients out in Virginia, we're in the process of helping them buy these properties that are currently 2 houses, one in the front and one in the back, and they're literally turning them into a 4-plex. Each unit's gonna be turned into a duplex. So there's ways to do this, but you have to be creative. You can't just say, okay, every deal is like, hey, this is a 3-bedroom, 2-bath house. I'm gonna buy it, rent it out, make a bunch of money. You definitely can do that in this market. I have clients all over the country doing that. The difference is the people who are really killing it are people who are taking and figuring out how can they make more of the house, whether that's adding an additional unit, renting out by the unit. There are more people now who are renting out by the room than I've ever seen, and they're killing it. Last week, I talked to a gentleman. It was in a place in Austin, Texas. He was renting, he was making over $6,000 a month on like a $250,000 home, which I don't know if you know this, but usually around, if you get 1% generally of the value, you're doing pretty good. I mean, this guy's getting 3x by renting out by the room. He's finding a way to make it work. And after talking to him, although this is starting to become a trend, he's been doing that for years apparently. So that's why he's kind of got it dialed in. The one thing about experienced investors too is that they have a game plan around the financing. So they speak to somebody like myself who's going to educate them and make sure that we can grow this portfolio and make sure when they're getting into these deals, they're not making mistakes. They have an exit strategy for the properties that they're buying. The exit strategy could be being able to buy a property, fix it, flip it, and get rid of it. Or it could be, hey, they're going to buy it, rehab it, and then they're going to refinance to something long term. And then making sure that they have everything set up correctly so they can get that financing and have success. The important thing is to talk to a professional. And if you'd like to talk with me, feel free to click down on the link below or DM me on Instagram. I'd love to chat with you about your scenario specifically. As somebody who's funded hundreds of loans with investors all over the country, I have a good insight on what it's going to take to not only get your loan to the finish line, but make sure we're setting you up with the right product and program available for you. So here's what investors are doing to win, even with values and rates being high. The main thing is how they're structuring their financing. Once they found a good deal in their market, or maybe it's in a different market they don't believe in, that's another side note here, which don't get stuck in your own market. I have tons of clients who are in California or in Texas or different parts of the country who are investing in, say, Alabama, Ohio, Tennessee, you name it, right? They take advantage of these other markets because sometimes your market might not be the best market. As an example, I have a ton of clients who are in Ohio and Georgia and Missouri and these different parts of the country where they actually can get a ton of cash flow on these properties. Now the values aren't as high, so it makes it easier for them to get into the game. They get a good amount of rent versus how much money they're having to put into it. So that's something to think about here as we're going into it. But beyond finding the deal, once the client has found a good deal that they want to take advantage of and they have a strategy about how they're going to maximize this property, whether that's renting out by the room, whether that's adding additional units, whether that's going to be going ahead and doing it as a short-term rental or a mid-term rental. Once they've came up with a strategy of what they're going to do with the property, the next thing is to figure out how they're going to finance the property. Now, we've talked about a little bit about this, but the game plan is essentially you have a couple different strategies. You're either going to do a short-term financing or long-term financing. What I mean by that is you're going to come in and you're either going to fix the property up and flip it, or you're going to fix the property up and hold it. If you're going to do that, that involves some type of a rehab loan, or maybe even a ground up construction. You're buying land and building up another property. That's a good way to build equity into a home right away, where basically on a ground up construction, when you build a property, you need to have a certain amount of equity in the home once you're done and the project's complete. Typically it's around 25 to 30% equity built into the home from the work that you did. That's a good way to kind of build momentum. If you have never done ground up construction or you want to start something easier, we can go straight into long-term financing, which long-term financing would be something like a conventional loan, which some people are doing, but the real investors are taking advantage of these non-QM loans. What I mean by non-QM is the most popular: DSCR, bank statement loans, asset utilization loans, P&L loans. I have dealing with a client right now who has about $5 million in an investment account. He's got no debt on his investment properties. We're doing an asset utilization loan where we can prove, hey, this man has $5 million. If he wants to pay off this $500,000 loan that we're going to get from him, he could do it tomorrow. So the lender's like, hey, he has more than enough to do that. We're going to give him the loan. Don't have to look at tax returns. Don't have to look at personal income docs. If you don't have a ton of assets like that, gentlemen, don't panic. The most common one that we utilize is a DSCR loan. A DSCR loan is where we qualify you based on the rental income of the property. So you can put away your tax returns, you can put away your income. And in fact, this is my favorite loan because it literally opens the doors to everybody. No longer do you have to be somebody who makes a ton of money. You can get into this game as long as we can prove that the rent is enough to cover the payment. Now, a couple of the key details: you do have to have a good credit score, typically a 620 or higher. The higher the credit score, the better the terms that you're going to get. If you want to put minimum down on these properties, typically around 20% down on a DSCR loan or any of these non-QM loans, you would need to have at least a 700 credit score with majority of lenders. There's a few lenders who allow you to go down to 680. The point being is that there's this option available to you where we can qualify you based on the rental income of the property, and as long as the rent is enough to cover the payment, the principal, interest, taxes, and insurance, the lender will go ahead and do the loan. So why not take advantage of that? And that's what my investors are doing. They're taking advantage of these loans where we can qualify them based on the rental income of the property. And then for whatever reason, if this asset does not DSCR, meaning that there is no positive cash flow on the property, we can look at other options. Well, if you're self-employed, we can do a bank statement loan. Bank statement loan is where we look at the last 12 months of revenue of your business, and we typically can get 80 to 90% of the revenue of that business. If you're somebody who's self-employed like myself, where you're writing off all this money for taxes because you're spending all this money in your business, well, guess what? Instead of qualifying you off that little number where you're having to figure out how we're gonna make these tax returns work, don't worry about it. You send in 12 months of business banking statements, and I've had people go from they couldn't qualify for a conventional loan to save their lives to their debt to income ratio on a business bank statement loan went down to 5%. 5% is basically nothing. And this person couldn't qualify and get below 50% on a conventional loan. To summarize, there's non-QM loans. Get educated on those options. Speak to a professional like myself or other broker who understands all the options that are available to you, so we can talk about how we can get you financed for these properties and get you into your first deal, or maybe get you into your 5th, 6th, 7th deal as you continue to grow your portfolio. So those are the strategies. But people are probably still thinking, should I invest in 2026? That takes us to section 4. There's no one size fit all answer for everybody, but there is a framework to help you make a decision. The first question you should be asking yourself is, do I have enough cash? Although a lot of people think that they don't need a lot of money to get into investing, the reality is you need a down payment, typically 20 to 25% of the property's purchase price. You also would need a reserves, which is like 3 to 6 months of the PITI of the property. You also are going to need to have money to fix up the property, or even do some cosmetic lipstick type of thing to the property. And lastly, you're definitely going to need to have closing costs associated with that, but maybe we can negotiate that with the seller. Regardless, you're going to need more money than you think, and it's better to be prepared for what you can't expect. A lot of people who don't have a lot of experience don't see the pitfalls that get involved. And that brings me to my next thing. Once you've spoken to somebody like myself to figure out exactly how much money you're gonna need and figuring out if you have enough. If you have enough, let's go, let's make a move. If you don't have enough, figure out what you need and then get to work on making more money. Now that's a different conversation. However, it opens up the conversation about, well, maybe you partner with somebody else. There's a lot of times I work with people who are partners, and that's some of my best investors. They've got 1, 2, 3, 4 people on an operating agreement that work together to grow their portfolio. With that said, the person who should definitely not invest right now is somebody who's not going to take this seriously. What I mean by take this seriously is a lot of people think that real estate is a passive thing. It's not passive. I promise you it's not passive. Maybe long-term, you've been investing a long time, you have this thing dialed in, you have a management team, okay, then maybe you can say it becomes passive. But if you're not willing to put in the time and effort to run a business and have a dialed in process to become a business, I highly recommend not getting into real estate investing. As for those of you who are waiting for timing to improve, or waiting for the perfect deal to come along, or waiting for the rates to drop, I just would recommend that you think otherwise. And not to say that you have to go buy a property in 2026 and that you can't wait for the rates to get better. But I am saying don't get your mindset on the sidelines just because things aren't as perfect as you thought. Maybe you just need to dig a little deeper and figure out another way to win. If you want help figuring out if right now is the time for you and how to structure your next deal, feel free to click on the link in the description below. We can work together one-on-one. Thank you for watching. See you on the next one.